Welcome to my economics channel, where I love discussing the subject, but most importantly, I love to make something fun and interesting to learn. And to that end, I want to ask the question, was I wrong about inflation in my previous video, where I basically lampooned Economics Explained's take on inflation, and in particular his take on hyperinflation? Now, to answer one part of the question, I do not believe, or certainly all of the evidence that we have right now says that hyperinflation is not coming anytime soon, and that we don't have to worry about that. However, as we've seen in the past few months, inflation is here. And so the question is, given this new data, how wrong was I about inflation back then? And so to that end, what I've done is I've looked at 15 different sources alongside other sources which I don't cite in the video. And basically, they fall in roughly two camps. Ones that say that yes, inflation is here and we need to worry, all the way to the other end of the spectrum where they say, yes, inflation is here, but it's temporary. This is a supply side issue, or predominantly a supply side issue caused by COVID, and it will die down, and we're going to get back to regular old inflation. And then there's takes that go in between those two extremes. But without further ado, enjoy this nice soothing B-roll, and let's get into the video. From the first article from the Financial Times, we see that China's producer prices rose at the fastest pace in 13 years. The producer price index rose 9% in May, the biggest year-on-year increase since the global financial crisis. Meanwhile, in April, prices rose 6.8%. And according to this article, this is driven by an international rally, i.e. a price increase, in commodity markets, as well as low base effects after being in negative territory for most of 2020. Consumer prices are still quite low in China, and according to this article, this will put the tight squeeze on producers selling directly to consumers. The authors fear that these high producer prices and high prices at leading Chinese factories will help fuel global inflation, given that China has a large share of trade around the world. The other factor at play is that China's currency has risen steadily over the past year against the dollar. And because of the rise of the renminbi, factory prices for machinery were rising in dollar terms. The end of the article states that while China is not obviously exporting inflation in its own currency terms, he noted that from a US perspective, rising prices of imports from China may start to feature in the debates about inflation. From the second article from Financial Times, which is essentially equivalent to an op-ed, we get the author saying that he suspects that the 5 trillion spending programs with near 0% interest rates and $120 billion a month buying program will move growth, inflation, and financial markets far beyond reasonable targets that will jeopardize any post-COVID recovery. The author then asks if hundreds of cryptocurrency, or the SPACs, special purpose acquisition vehicles, are the result of continuing financial innovation or a product of cheap and plentiful credit provided by deficit spending and an accommodating Fed chair. The author claims that the interest rate on the 10-year Treasury rests, quote, illegitimately at 1.65%. And the author spends the rest of the piece talking about Treasuries and Fed and bond purchases. He then mentions how once employment falls, inflation will start roaring again. From the third article, we begin with a description of the December meeting of the Federal Reserve's most important economic committee. The article claims that policymakers agreed that the economy could cope with rising levels of spending, quote, without any strong general upward pressure on prices, end quote. Although the prices for a few raw materials were rising sharply, quote, finished goods have not been subject to pervasive upward cost pressures, end quote. That all sounds quite banal and standard. However, there is a minor twist to the story, as this actually describes a meeting of the Federal Open Market Committee on December 15, 1964, just 2 weeks before the start of a 17-year period that the Fed now dubs the Great Inflation. The article then goes on to explain how policymakers and central bankers have not had to deal with the problem of inflation during their own careers. This is because inflation has been mild the past 30 years or so. The reason for the 2% target? Or at the very least the theoretical reason is that a literal inflation helps, quote, grease the wheels of the economy, end quote, allowing declining sectors to fall behind gracefully. Higher inflation eases economic adjustments as it creates more scope for changes in relative wages without the need for, quote, an outright falling wages in sectors under pressure, end quote. And because in most advanced economies, the US, the Eurozone, and Japan, central banks are falling short of meeting this inflation target, this means that they are in favor of a period of higher inflation. And until this year, the main economic concern regarding prices was the risk that countries were turning Japanese and, quote, might soon emulate the nation's 30-year struggle with mild deflation, end quote. The article goes on how the new concern about rising inflation, that this is not just the result of immediate effects of the pandemic, but reflect longer-term underlying changes in the structure of the global economy. This is happening at the same time as when the global economy is feeling the impact of aging populations and a maturing of China's 40-year transition. From the end of World War II up until the 1970s, the view at the time was that there was very little risk of inflation. Then came the first OPEC oil shock and a switch to government policy from austerity to massively excessive stimulus, pushing the economy beyond any reasonable estimate of the sustainable level of unemployment. The present stimulus spending would exceed the capacity of economies to provide goods and services, especially if the government support has left people less willing to work, creating labour shortages and significant pressures on companies to raise wages. A situation of elevated demand and more constrained supply might not be fixed any time in the future. And even Janet Yellen, who claims that the stimulus is required, says we need to make sure that our economy doesn't overheat and that higher interest rates may have to come sooner than what was initially thought. There is the idea that globalization has led to a large transfer of the production of goods from high-wage economies to China and Eastern Europe, which has accelerated the decline in the power of workers in these advanced economies, meaning employers didn't have to increase their workers' wages, which helped keep prices low. Goodhart, who is quoted in the article, claims fewer new workers are becoming integrated into the global economy, and at the same time we have a shrinking workforce in advanced economies as populations age, which in turn will raise the pressure on companies to raise wages, which will then put pressure on inflation in the economy. The article then quotes Lawrence Boone, chief economist of the OECD in Paris, who claims it is too early to ring the alarm bells about inflation. He claims that in most economies there remains significant slack in the labour market, and that the big demographic pressures will be lowered significantly with later retirement, while other parts of Asia and Africa would be delighted to integrate into the global economy as China once did. And finally, according to this article, this view represents the consensus opinion among economists, and that there is significant confidence in central banks that any rising inflation this year will be temporary and easily tamed without having to tighten policy significantly. Then the article concludes that this is the first time in many decades that there is a possibility that a significant turning point has arrived and that price rises will be more than a flash in the pan and will be more difficult to control. From the fourth article, which is from the Brookings Institute and which was written in 2019, the author claims that absent the extraordinary fiscal policies undertaken by many governments around the world, that real interest rates would have fallen far below the current, slightly negative level. Current and prospective inflation would be far short of the 2% target levels, and that past and future economic recoveries would have been even more sluggish. This is the idea of secular stagnation, quote, a condition where there is negligible or no economic growth in a market-based economy. In this context, the term secular means long-term, and I'm sorry in advance I'm going to butcher this, but it's from the Latin saeculum, or century, or lifetime, and is used in contrast to cyclical or short-term, end quote. We can thank Mr. Google for that. Using complex modeling techniques, the paper argues that neutral real interest rates have declined by as much as 3 percentage points over the last generation absent the extraordinary fiscal policies. Neutral real interest rates are an idea that savings and investments are equal and that the economy is at full employment. The significant decline would have been far greater except for the build-up of government deficits and debt over the last generation and the increasing generosity of social insurance programs and particularly increases in old age pensions. And from the fifth article, this time from Vox EU, the author goes into some detail using a few models of inflation and inflation expectations for 2021 and beyond. It also looks at inflation in the past and how this inflation has remained relatively low and stable for the past 3 decades. The article looks at unemployment and how this has impacted inflation alongside a measure of core inflation that does not include food and energy prices, but that this latter measurement does not reliably reflect macroeconomic conditions. For example, during the 2017 and 2019 expansion, this core measure of inflation was actually below the long-run expected level for CPI inflation based on a survey of professional forecasters. It fluctuated wildly between minus 1.1% in the second quarter of 2020, the largest fall being in the services industry, with record drops in airline fares, lodging, apparel, and motor vehicle insurance prices, to a rise of 3.9% in quarter 3 of 2020. The article argues that the 1960s inflation took off after the Great Society programs ran alongside the Vietnam War, and that these were considered to be more longer term and more permanent changes to the economy. The article claims that a more appropriate reference for today, and a more appropriate comparison point, is the temporary government spending and inflation that occurred during the Korean War in the early 1950s. The author states that the Fed's communication and policy framework is more credible and consistent with more explicit goals than what it had in the 1960s and the 1970s, which has helped anchor inflation expectations over the past 3 decades. The structure of the economy is now more open to foreign competition and labour markets are more flexible, which would help further dampen price pressures. The main point behind the spending that is happening today, regardless of its actual size, is that it's considered temporary in the sense that it is meant to be unwound after the economy returns to normal and people get back to work and supply returns to where it was before the pandemic started. Based on the fact that this is considered pandemic relief and not something to fundamentally reorient or change society, the article argues inflation expectations will remain relatively low for the foreseeable future. Article number 6 is from Bloomberg, which was written on 27th of December to be precise, and is entitled, "Get Ready for the Great US Inflation Mirage of 2021. Arguably, this article has not aged particularly well, since it says that there will be higher inflation in 2021 and that it will be slightly above 2% and nowhere near the 5% that we are seeing now. And the biggest thing they are saying is that unemployment will still remain relatively high, which will push down wage increases, and this will help keep prices low, and this will mean we won't get runaway wage inflation. Quote, "In 2019, we had a really perfect storm for higher inflation with lower unemployment, goods tariffs, and a weaker dollar from prior years," end quote, said Matthew Lazzetti, chief US economist at Deutsche Bank AG. Quote, "And that really only got us not even back to the Fed's core inflation objective, so achieving above target inflation is a really difficult thing for the Fed," end quote. Article number 7 talks about how central bankers on both sides of the Atlantic say the recent price rises are temporary consequences of the whiplash effect of the COVID-19 pandemic on demand. As supply chains have been thrown into chaos and the supply of many commodities has decreased, which was exacerbated by demand falling sharply and then surging back really quickly. The idea is that this temporary rise in demand, which can only rise so high, is causing the inflation that we're seeing right now. The article then summarizes what happened in the 2010s, where what happened was that instead of all the stimulus causing inflation, actually there was near deflation in the US and the Euro area, and a few other advanced economies. The author argues this was because of the austerity measures put in place by governments during this time. This was a period of quantitative easing. where central banks were buying up a large number of government bonds. The only inflation this resulted in was asset price inflation, from everything to property to stocks and shares. The author says that particularly in the US, falling rate of unemployment was flattered by increasing number of people giving up looking for work and dropping out of the labor force entirely, and that this was a system of the core problem of insufficient demand from businesses and consumers. There was also a structural shift in the labor market, where most of the jobs created were in low-skilled and low-paid jobs in sectors such as leisure, hospitality, and logistics. The author argues that one of the lessons from the 1970s inflation is that inflation was really only subdued after central banks were given operational independence from politicians to pursue low and stable inflation. As monetary policy became more credible, people no longer expected prices to rise as fast. One of the reasons we didn't have inflation in the past few decades was well-anchored inflation expectation. In sum, the author expects that there is inflation in the short to medium term, but that the longer-term picture is much more mixed. This is because globalization has arguably led to worldwide deflation, where much of manufacturing has moved to poorer countries with lower wages, which is pushing down wages for similar workers in advanced economies and pushing down wage growth. But with China's maturing economy and rising wages and an aging workforce, this could lead to inflationary pressures. The author concludes by saying, if there is higher business investment and labour participation, government budget deficits will narrow faster as the private sector gets back into gear and pays more in taxes, which will allow the Fed to find a smoother exit from quantitative easing, since increased bank lending will more likely lead to sustainable economic growth rather than just fuel inflation. Article number 8, which was written on April 13, says that the inflation jump was pushed up by a 9.1% jump in gasoline, as a surge in gasoline prices accounted for about half of the gains amid signs of an accelerating economic recovery. Quoting Michael Pierce, the author says, "This is the clearest indication so far the signs of mounting inflation evident in business surveys and producer prices beating through to stronger consumer prices." End quote. He then continues, quote, "All of the focus and supply disruptions pushing goods prices higher, the strongest upward pressure on prices is coming from the services sector." End quote. Food nudged higher up as well, up 0.1% for the month and 3.5% for the year. The food at home category increased 3.3%. All 6 of the government's measures of grocery store indexes rose, with the biggest gain of 5.4% in the category of meats, poultry, fish, and eggs. Food away from home increased 3.7%, while limited services meals, which includes pickup, takeaway, and delivery restaurants, jumped 6.5% for the year, the largest annual increase in the survey's history dating back to 1997. The article goes on to say that many economists and experts expect inflation to be transitory, but that markets have been pricing in higher growth and inflation, with government bond yields rising to the highest levels since before the pandemic. Article number 9 is very similar to article number 8, and adds that used car and truck prices, which are seen as a key inflation indicator, surged 21%, including a 10% increase in April alone. Shelter, another key CPI component, was up 2.1% year on year and 0.4% for the month. The article further argues that one of the reasons for higher prices and higher levels of inflation was a base effect, because inflation was very low at this time in 2020. Lumber prices have also increased dramatically, up 124% in 2021 amid persistent demand for building materials. Meanwhile, copper, which is often seen as a proxy for economic activity, jumped nearly 36%. We then get to article number 10, and we understand that investors are not exactly reassured by the Federal Reserve and its insistence that inflation will be temporary. The article also states that if food and gas are set aside, so-called core consumer prices rose an even stronger 0.9% in April. That pushed the yearly rate up to 3% from 1.6%, the highest level in 26 years. The article says that inflation will stay high because businesses can't get many vital supplies on time or at reasonable prices, and now the cost of labor is also going up. Bill Adams, a senior economist from PNC Financial Services, says, quote, "The stimulus checks, job market dislocations, and supply chain issues caused by the pandemic are short-term drivers of inflation, and the Fed will look past them in setting interest rates. But there are ways to show how this temporary inflation could turn more permanent. Higher wages employers are using to attract workers could be inflationary over time. Buoyant consumer demand would fuel a faster recovery than expected, or the upward price shocks would fuel higher inflation expectation." End quote. From article number 11, we get the following quote from BCA Research. Quote, "Fears about inflation are not out of order. Chinese consumer prices spiked in April, raising the risk of imported inflation." From article number 11, we get the following quote from BCA Research. Quote, "Fears about inflation are not out of order. Chinese consumer prices spiked in April, raising the risk of imported inflation." Tuesday's National Federation of Independent Business survey showed that the share of owners raising average selling prices increased to a net 36% in April, the highest level since 1981. End quote. From the article, we understand that people are wondering whether the Federal Reserve's policy of allowing inflation to run hotter than the 2% annualized target while the labor market continues to improve will prove incorrect. The article also reiterates the idea that companies are having difficulty hiring workers and the need to raise wages to attract new employees or retain existing workers. The article claims that the real risk to the economy is growth being higher than expected, running the economy hotter and therefore necessitating higher interest rates from the Fed. BCA Research thinks the biggest surge in activity is still on the horizon, but there are significant growing pains, with longer lead times, a lack of available labor, and supply constraints. Quote, "These challenges are as disruptive to multinational manufacturing operations as they are to independent tradespeople, and even the most basic service providers, with shortages ranging from microchips, 2x4s to chicken wings." End quote. From article number 12, we understand that one of the key reasons for inflation is that the stimulus-fueled economy is booming, and the article forecasts that output will be higher at the end of the year than it would have been had there been no pandemic, and instead the economy had continued along its 2014 to 2019 trend. They also talk about rising commodity and freight charges combined with supply chain disruption and component shortages that have led to increased costs. This is in addition to labor shortages, which are also on the rise as homeschooling requires many parents to focus on childcare rather than go to work, while extended and updated unemployment benefits mean firms have to pay higher salaries to attract staff. The article then states that, fortunately for businesses, a strong demand environment means that these higher costs can be passed on to consumers, which of course means higher inflation. The article also says to watch housing costs in coming months, as these will be a good indicator for what is happening with inflation. And then the article ends by saying that they think the Fed will have to raise interest rates earlier than 2024, and they predict it will happen in the first quarter of 2023. From article number 13, we get a different take on inflation. That's because this article is all about how COVID has disrupted the way we measure inflation. Inflation is measured using a basket of goods and services, which is meant to represent what people typically purchase, and items are given weight proportional to the amounts spent on them. However, people stopped spending on restaurants, airfares, and other lockdown restricted activities practically overnight. And from the article we get, quote, "As a result, some countries' real-world experience of inflation differed from the official headline rate by as much as 0.89 percentage points in a single month last summer," end quote, according to research by Harvard professor Alberto Cabello. According to Cabello's estimates, US inflation may have been underestimated by 0.5 percentage points over the course of 2020. The article then states that spending on groceries increased 29% in March last year, according to credit and debit card purchasing data from Opportunity Insights. The surging demand pushed prices up 2.7% month on month. By contrast, transport spending declined 70% in April last year, and prices dropped 7% at the start of the year. And the effect has lasted, with spending on transport still 85% below pre-pandemic levels in May this year. As the US economy reopens and lockdowns end, the effect has reversed. A decline in production of cars and trucks over the past year has pushed up used vehicle prices. Since Americans have spent less on transport since the start of the pandemic, that suggests April's official inflation reading, which recorded a really big jump, was probably an overestimation. Article number 4 looks at the used car market and the new car market in detail. The article also states that during this recession, the number of customers who defaulted on vehicle finance and had their car repossessed has actually declined, cutting another source of revenue for dealers. Stimulus measures have helped Americans spend on new and used vehicles, and rental car companies that sold off their fleets as travel collapsed last year are now scrambling to rebuild them with used vehicles. From article number 15 and the final article, we understand that US Treasuries registered their best week in a year as investors apparently shrugged off the highest inflation rate since 2008 and piled into government debt. The benchmark yield on the 10-year Treasury note fell by 0.103 percentage points to 1.45%, notching its largest weekly decline since June last year. Apparently, this move has been propelled by declining inflation expectations in the market. This suggests a growing willingness amongst investors to accept the Federal Reserve's stance that higher inflation will prove temporary, settling down once the comparisons to last year's lockdown economy have run their course. Many fund managers have bet that the Fed would have to respond to the inflation spurt by scaling back its monetary stimulus soon. And so, taking all of that together, what can we say about inflation? Clearly, inflation is here. It's been above 5% for 3 months now, and most likely will be at an elevated level for quite a number of months, at least until the end of the year, and most likely well into next year as well. And so, to answer the question that I asked at the start of the video, yes, my take on inflation, when I was talking about the EE video, was mostly incorrect. Of course, once again, hyperinflation is not here, and all evidence says that it's not coming anytime soon. But it all now, I believe, comes down to the Fed and how it reacts to inflation. We've already seen that the Fed has a new average inflation targeting framework, meaning that depending on how far back it looks with its undershooting of inflation, it wants a similar period going forward where it overshoots inflation, and then over that entire period, let's say 10, 15, maybe even 20 years, I'm not entirely certain, and they certainly haven't gone into details, but over that entire span, average inflation is 2%. Because right now, over the entire period, the average level of inflation has been less than 2%, whereas the Fed targets a 2% inflation rate. The other reason I say that it largely comes down to the Fed, and of course other central banks around the world, is that one of the big reasons that we've had this great moderation of inflation in the past 3 decades is because people credibly believe central banks and the fact that they're autonomous and that they are going to target inflation and that they want that low and stable level of inflation. And of course that the central banks are free from political influence and that can target these macroeconomic indicators in an almost rule-like manner. And so you can almost imagine we have like sort of almost like technocrat overlords. They're sort of running the strings or pulling on the strings of the economy, if you will. And we believe that going forward, they're going to maintain a low and stable rate of inflation. But if those inflation expectations become unmoored or unanchored or whatever other metaphor you want to use, then people could start pricing in higher inflation. They might start demanding higher wages, prices might start going up in the aggregate, and then we might start to see runaway inflation, or at the very least inflation in the medium term that's much higher than we want. And so of course, all of this is an academic exercise, but I still hope this video was useful to you. and help to allay at least some fears about inflation going forward. And of course, that this plays out like central banks think that it will. So that's the end of my video. Thank you for watching. If you have any questions, don't hesitate to ask them below, and I'll do my best to answer. Or at the very least, I'll collect all the questions and I'll put them together in another video and I'll answer them there. Otherwise, once again, thank you for watching. If you wouldn't mind subscribing, that would be amazing as it helps my channel grow. Share it, like it, all that good stuff. And I'll see you guys in the next video.